Hi, and welcome to Early Retirement Roadmap, the show where I help you prepare for and thrive in early retirement. If you're planning to retire early or you're already there, there's one problem you can't control. It's the market. But you can control whether the market can force you to sell at the worst possible time. And that's what a cash runway is really about. Today, I'm going to break down what a cash runway is, how to figure out how much to have, and all the practical ways to build it, including the trade offs of each method, because there are a lot of podcasts telling you why runway matters, but not many that actually explain how to build one in real life. Before we get into it, this podcast is for educational purposes only and is not personalized financial, tax, legal, or investment advice. All right, quick credit here. This topic was suggested to me by Jesse, a podcast listener, who reached out to me regarding my recent podcast titled Choppy Markets, Use This Retirement Defense Plan, where one of the defenses I talked about is having a solid cash runway so you don't stress over market downturns in retirement. Jesse asks, I get the why, but how would you suggest someone nearing retirement go about doing this? Reducing 401k contributions, selling invested assets, curtailing spending, each has its pros and cons. Now, that's a great question, and I really appreciate Jesse's suggestion to cover this topic, as it helps me to know what might interest you, my audience. So if you have a topic you want me to cover next, email me at mike@mikeupland.com. That's the easiest way to get a message to me. All right, let's get into it and cover Jesse's question and more. So cash runway is money you're setting aside to cover your spending in retirement for a period of time. So you are not forced to sell stocks when the market is down. And when I say spending, I mean your real all-in spending, your regular bills, plus things like health insurance, taxes, all the big predictable stuff that shows up after you stop working, and you should build in spending, of course, for any unexpected expenses too. It's not money you're setting aside to time the market and invest later. It's money to buy you time. Because what really hurts retirees isn't just a market downturn, it's a downturn early in retirement combined with selling to fund spending in retirement. That sequence of returns risk, which can have a detrimental impact on the long-term trajectory of your portfolio and its longevity. And having a good cash runway is your seatbelt. It lets you keep your hands off the wheel when the market's, well, just not cooperating and taking a hit. Now, two quick warnings before we talk numbers. Number one, a runway is not the same thing as having bonds. Bonds can be part of a safety plan, but bonds can also go down. So if your runway is built on stuff that can drop when you need it, that's not really a runway. Number two, you can build a runway wrong. The two most common mistakes are, first, people hold way too much in cash for way too long and they quietly bleed to inflation. Second, they build something that looks safe on paper but doesn't actually protect them in a bad year. So what we want is a runway that's big enough to avoid sequence of returns risk, avoiding selling in a down market to fund retirement spending, but not so big that you're dragging an anchor behind your retirement plan. So how much should you have? Here's a simple version. Pick a runway length, 2, 3, or 4 years perhaps, and multiply that by your estimated annual spending needs. That gives you the runway target, and then you decide how conservative you want to be based on your flexibility and your risk tolerance. If you want a guideline that actually matches how markets behave, you can think in terms of 3 buckets. If you're flexible, calm, and you have other income options, guaranteed money in retirement like rental income or a pension or Social Security, 1 to 2 years may be enough. If you're moderate, which is most people, 2 to 3 years often works. And if you want the sleep well at night version, then 3 to 4 years is a very reasonable target. And if you're the type of person who knows you will not sleep during a downturn or your spending is not very flexible, then 4 to 5 years is the ultra conservative version. Just remember, the longer the runway, the more you're trading growth for comfort. So I like to treat 4 to 5 years as the I never want to worry option, not the default for everybody. Now, why plan a multi-year cash runway? Because historically, bear markets and recoveries are usually a multi-year event. For example, the Schwab Center for Financial Research looked at S&P 500 bear markets going back to 1961 and found the average bear market lasted roughly 13 months and that the market has typically returned to its prior peak within a few years. And JP Morgan Asset Management has a long history chart of S&P 500 bear markets going back to 1929 that shows an average recovery of about 39 months. Now, different studies use slightly different definitions, time periods, and start endpoints, so don't get hung up on the exact month count. The point is the same no matter how you measure it. The down part plus recovery part is often measured in years, not weeks. So, however you slice it, down plus back to break even is usually not a quick bounce. It's often several years. And that's the takeaway, not the exact month count. And that's why I like a 3 to 4 year runway as a practical target for most early retirees and 4 to 5 years if you want that extra sleep bullet night buffer. The right runway is the shortest runway that keeps you from doing something stupid in a bad market, like selling at a loss to fund retirement spending. That's the goal. Okay, let's talk about the part nobody explains well. How do you actually build this runway if you don't already have it? I'm going to split this into two separate questions. Question one, where does the money come from? That's building the runway. And question two, where do you store the runway once you have it? That's holding the runway. Those are two different topics, of course, so let's start with building it. I'm going to give you every common realistic option and I'll be blunt about the pros and cons. So here's the clean way to think about it. There are only 4 ways a cash runway gets built. First, you redirect cash flow. Second, you can convert assets to cash. Third, you can let cash build naturally. Or fourth, you can keep a backstop. Our first way to build a cash runway is to redirect cash flow, which is best done before retirement. This is the use your paycheck category, and it's the cleanest way to build a runway because you're not forced to sell anything. Our first option in this method is to save cash on purpose. Set an automatic transfer every payday into a separate account. The pros are it's simple, consistent, and no forced selling, but cons are it takes time. Option 2 is temporarily redirect contributions of the match. Consider reducing your 401k or 403b contributions. Here's the rule I follow. Definitely don't give up that employer match. That's free money. But if you're maxing out your 401k or 403b and you're within a few years of retirement, it can make sense to temporarily lower contributions above the match and redirect that cash into your runway. The pros are it builds the runway fast using money you were already planning on saving anyway, and the cons are you're giving up some tax advantage investing for a period of time. That's the trade-off. Option 3 in this method is do a runway sprint. This is where you're cutting spending for a defined period. This is not a forever lifestyle change, it's a sprint. For example, if you're 24 months out from retirement and you want to build a $200,000 runway, you're talking about roughly $8,300 per month. And that's why most people do this with multiple levers, redirect contributions, cut spending, maybe add income, instead of pretending one lever will do it all. The pros of the runway sprint is you're making a solid contribution to your runway. The cons are you feel it because you're cutting spending you've grown accustomed to, so it's a change in lifestyle temporarily. Option number 4 is add income for a defined period. Consider overtime, a part-time consulting gig, anything that creates extra cash flow that can go straight into the runway. The pros are you don't require selling anything, but the cons are your time and energy. Our second way to build the cash runway is to convert assets to cash, which can be done before or during retirement. This is a category people get nervous about because it sounds like selling, and yes, sometimes it is, but when it's planned, it can be the cleanest on-ramp into retirement. The first option under this is to use the taxable brokerage account to fund the runway. This is why I'm always talking about taxable brokerage accounts. They give you flexibility. If you've built up a taxable account, you can sell a portion to create or top off the runway. The pros are it's flexible, there's no age restrictions, of course, and it's liquid, so it can really help with building your cash runway. The cons are taxes can be triggered, of course, and the biggest risk is waiting too long. What I mean by this is if you wait until the market is already in a noticeable downturn and then you try to create your runway by selling stocks, that kind of defeats the purpose. So ideally, you use this to build or top off your runway when markets are normal or up, or you do it gradually over time so you're not forced into selling at the worst possible moment. And yes, this can be done before retirement. In fact, if you're 2 to 4 years out, gradually building the runway from a taxable account can be a very practical path. Option number two, sell other stuff if it fits your situation. This could be done by downsizing, getting rid of a second car, selling unused assets, or simplifying things you don't need going into retirement. The pros are it's a one-time boost and it also simplifies your life, but the cons are not everyone has this lever. It's not repeatable, of course, because once you sell something, it's well sold. Our third way to build a cash runway is to let cash build naturally, and it works before or after retirement, but it's slow. The first option under this is let dividends and interest accumulate as cash. Some people don't want to sell a big chunk at once, so they can set dividends and interest to go to cash and then help slowly build the runway. The pros are it's gentle, it doesn't feel like a big decision, but the cons are it's slow and it usually won't build a longer runway quickly by itself. So treat this as a supplement, not the primary plan. And the fourth method to build a cash runway is to use a backstop. Here, you could consider using a line of credit as a bridge. A HELOC is the classic example. That stands for Home Equity Line of Credit, which is basically a revolving line of credit secured by the equity in your home. The pros are it reduces how much cash you must hold, but the cons are that lines can be reduced or frozen, rates can jump, and borrowing can add some emotional stress. So I don't like this as plan A, but it's a last resort bridge and it can be part of the toolkit. Now, when to use what? Here's a quick timing I'd use. When you're 24 to 36 months out from retirement, focus on redirecting cash flow. This is the cleanest runway building window. If your numbers say you need longer time to build this, well, start earlier. When you're 12 to 24 months out, keep redirecting cash flow and start thinking about the structure you hold the runway in, because this is where it goes from a pile of cash to an actual system. For example, this is when you decide things like, am I doing a CD ladder? Am I doing a treasury bill ladder? Or am I keeping it simple with a high yield savings account or money market fund plus a ladder? And don't worry, I'm about to walk through the pros and cons of each storage option next. Also, if you have a taxable account, this is a reasonable window to gradually build or top off the runway. And when you're 0 to 12 months out, finalize the runway and finalize the rules. Okay, now you know how to build the runway. But once you have the money set aside, where do you put it? Because where you store it matters. This is where people either get too conservative or they accidentally take on risk. We want our storage places to be safe, boring, and predictable, and I'm going to lay these out from simplest to more structured. Storage option 1, plain cash and checking or savings. The pros are it's instant access, the cons are low yield and inflation drag. This is fine short term for paying immediate bills, but it's not great for long term storage. Storage option 2, high yield savings or a money market fund. Quick clarification because people mix these up. A money market fund is usually something you buy inside a brokerage account. A money market account is a bank account. They're different products. I'm talking about the fund version here. Now, one important safety nuance: a typical high-yield savings account is a bank deposit and is usually FDIC insured, so it's very straightforward. And if you're holding a large runway, be mindful of FDIC coverage limits and consider spreading deposits across institutions if needed. The limits are typically $250,000 per depositor per FDIC insured bank per ownership category. A money market fund is not FDIC insured. It's an investment fund that tries to keep things very stable by owning high quality short-term stuff. So what's the trade-off? The pros: the money market fund is still simple, very liquid, and yields are often competitive, sometimes higher than a high yield savings account, sometimes lower. The cons are the yield changes, and because it's not FDIC insured, you want to use this tool thoughtfully. My practical take: if you want maximum simplicity and the cleanest sleep well safety story, the high yield savings account is hard to beat. If you use a money market fund and keep it boring, the kind that's focused on very high quality short-term holdings, and always understand what you're buying. Either way, this is great for the first chunk of your runway, meaning the money you'll likely touch soonest. Think of it as your bill pay buffer, the next 6 to 12 months of spending plus a little extra for surprises. You want that first chunk to be super liquid and boring, so if the market is having a tantrum, You can just pay your bills, refill your checking, and move on with your life without having to sell stocks or break a CD early. That leads us to storage option 3, a CD ladder. Here you set up CDs that mature at intervals, for example, 6, 12, 18, 24, 30, and 36 months. Pros, it's very predictable, it's set and forget it, very easy to understand. Cons are early withdrawal penalties if you need that money early. And here's another practical con. Always compare the CD rate to what you can get in a high yield savings account. Sometimes a high yield savings account or money market fund is paying the same or even more, and you get the easy liquidity with no ladder to manage. So if you're going to use CDs, make sure you're actually getting paid for giving up that flexibility. And one more nuance to keep in mind, CD rates are locked in for the term, but high yield savings account rates can drop anytime. So even if an high yield savings account is higher today, a CD can still make sense if you want rate certainty for the next 6 to 36 months, for example. And remember, high yield savings account rates can also go up. And if this is runway money you plan to spend on a schedule and the rates are attractive, a CD ladder can work really well. Storage option 4 is a treasury bill ladder. It's a very similar concept to the CD ladder, but instead of CDs, you use treasury bills. The pros are high quality investment, flexible laddering, and strong liquidity. The cons are there's a slight learning curve. And one practical caution, same idea as CDs, compare the yield to what you can get in a high yield savings account or money market fund. Again, if a high yield savings account is paying about the same and you value simplicity and instant access, you may want to use the high yield savings account. But here's where T-bills can still win even if the headline rates look similar. Rate certainty, like CDs, you lock the yield for that specific bill until it matures, and the state tax perk. T-bill interest is typically exempt from state and local income taxes, which can make the after-tax yield better depending on where you live. One more nuance, if you ever sell a T-bill before maturity, for example, if you buy it in a brokerage account, you can get a small price change. It's usually minor on short maturities, but it's not the same as being able to pull your money out any day and always get exactly what you put in, like a bank account. If you buy T-bills at treasurydirect.gov, which is the U.S. Treasury's website for buying treasuries, you generally plan to hold to maturity, and the ladder works by bills maturing on schedule. But once you set it up as a ladder and let it mature on schedule, it's basically on autopilot. Storage option 5, short-term treasury or short-term bond funds. These are the one fund simplicity option. Pros, very easy, very liquid, but the cons are the price can fluctuate. Usually modestly, but again, if it's runway money, you don't want surprises. So if you use these funds, keep it short-term and high quality. Storage option 6, intermediate bonds as a secondary buffer. This is where a lot of people get confused. They want their runway to earn something, so they push further out on duration, but longer duration bonds can go down when rates rise. So if your plan is my runway is bonds, just remember bonds can be volatile too. That is why it can be best to have your core runway as a combo, a high yield savings account or money market fund for the part you'll touch soonest, which is your bill pay buffer, often 6 to 12 months. Then for the next chunk, the money you'll likely spend for the rest of the years in your runway. In many cases, this is ladder territory, a CD ladder or a T-bill ladder, because you get rate certainty and a payoff schedule. But if you find a high yield savings account or a money market fund that's paying better and you want maximum flexibility, you can absolutely keep more money there too. Just remember those rates can change, so you may need to reassess occasionally. The point is not ladders are magical. The point is for the money you might actually spend in the next few years, you want it in places that are boring, predictable, and not going to surprise you with price swings. That's why it's good to be cautious about relying on bond funds for the core runway. Even high-quality bond funds can drop when rates rise. So when I say use bonds as a secondary tool, I mean this. After you've protected that core runway, your bill pay buffer plus whatever ladder you choose, then you can keep a smaller sleeve of high quality bonds behind it as an extra shock absorber. That bond sleeve is not what you plan to live on first. It's what you might lean on later if the downturn lasts longer than expected or is part of your long-term allocation. Now, let me give a simple template that works for a lot of early retirees. If your target is a 3 to 4 year runway, I'd like to think of it like this. First, keep 6 to 12 months in high yield savings or a money market fund. That's your bill pay buffer. Second, keep the next 2 to 3 years in a ladder, either CDs or treasury bills. That's the part that pays you out over time so you don't sell stocks during a downturn. Third, optional and only optional, you can have a small secondary buffer sleeve in high quality bonds. But do not confuse that sleeve with the runway. The runway is your boring, predictable money. The phrase to remember is cash for now, ladder for next, rules to refill, because the refill rules are where people fall apart. The refill rules are really three. With these, you're turning the runway into a system. Rule 1, you refill your cash buffer from the ladder. In other words, your ladder is constantly maturing and feeding cash. Rule number 2, refill the ladder when markets are good. You do that by rebalancing. Stocks go up, you trim a little, and you refill the ladder. Not because you're predicting anything, because you're maintaining the system. Rule 3, review once per year. This is not a weekly hobby, picking annual date. Review your spending number, review your runway, and adjust. That's it. Now let's hit the biggest mistakes quickly. Mistake number 1 is holding 7 to 10 years in cash because it feels safe. That's more cash than most people need for a runway, and it can quietly hurt your plan over time. Mistake number 2, counting volatile assets as runway. Long-term bonds, dividend stocks, anything that can drop meaningfully when you need it. Mistake number 3, no refill rules. People build a runway once and then never maintain it. Mistake number 4, waiting until the last minute. If you're within a year of retirement and you have no runway, you have fewer choices. And remember, this isn't about predicting the next crash. It's about never being forced to sell at the wrong time and being resilient during market downturns and recoveries in retirement. Getting rid of that worry so when the market downturn and recoveries do happen, you can stay calm and treat it like background noise. Before I leave today, I want to share with you some freebies you can download from this episode's description or show notes. First, I have my free 12-step early retirement planning checklist, a practical, easy-to-follow guide that walks you through everything from calculating your FIRE number to building a tax-efficient withdrawal strategy. Second, if you're looking for ways you can save on premiums, if you're on ACA health insurance, especially if you retired early or are planning for early retirement, download my free ebook titled ACA Premium Shock Fix: 10 Ways to Pay Less for Marketplace Coverage All Year Long. It has lots of great information on the levers you can pull to lower your MAGI or modified adjusted gross income to get as much premium help as possible. And along with that, download the free MAGI Excel template you can use to both estimate and track your MAGI during the year. Especially important this year if you're on ACA health insurance, so you can stay under 400% of the federal poverty level based on household size. I'll include a link in the description for that information to get and maintain subsidies, otherwise known as advanced premium tax credits. If you download the template, I'd also suggest listening first to my podcast episode titled ACA MAGI: How to Calculate and Manage It for Big Savings, that explains in full how MAGI is calculated in detail. And remember, when you're not on the go, check out my Early Retirement Roadmap YouTube channel and go to mikeupland.com for all of my media. Well, that's all for today. Thank you again to Jesse for suggesting the topic for today's episode, and to all of my listeners, take care and make the most of today.